Hello and welcome to the next video. We're going to start this one on page 423 and we're going to go through probably page 428. All right. This short discussion is about SEPs and simples and qualified plans. All of my years of doing taxes, I have yet to see anybody honestly have a simplified employee pension plan, otherwise known as a SEP. All right, they're out there. It's just that a lot of small business people don't have a lot of money, and so putting aside a big chunk of money into a retirement plan is just something that they really don't do. Now they might do this later on, but usually the people that I've dealt with, they incorporate, and then they would start something called a simple IRA, which is also discussed in this book, and it's basically on page 424. Okay, but what these are is they basically follow the same rules as other retirement plans. You can set aside a certain amount of money, and those contributions are mentioned on these pages. All right. You cannot receive a distribution prior to the age of 59 and a half, otherwise you will be subject to additional penalties, including the federal income tax and state and local income tax that you would have to pay in the state of Indiana. When I first started my tax business way back in the 90s, all right, they were just introducing simple IRAs, okay, and that's the one that I had to set up because I was incorporated, all right, and I set one up and worked out real well. It is simple. It only takes one simple form to fill it out. I don't know what the fees are. I haven't been fully self-employed for 10 years, but back then the maintenance fee that my broker charged me was only $10 a year. So it's not a lot. It doesn't cost a lot to open up a simple IRA. It doesn't take a lot of money to open one. Usually it's like $500, and you're off and running. Okay, and then you make contributions to your IRA, to your simple IRA, when you want to. Okay, all right. Large employers, of course, would have something called a 401k, or places like Ivy Tech, which are government positions, you would have a 403b. By the way, if you're wondering where these numbers come from, these are the sections of the Internal Revenue Code that define all of these provisions. So if you were to go to the Internal Revenue Code and you went to section 401 paragraph K or section K, all right, you would see the discussion of deferred compensation plans. Okay, so you want to be cognizant of all the limitations that are outlined on pages 424 and 425. For example, 401ks, you can only contribute up to $18,000 total, and and also you would also want to note, what are the employer contributions? How much are they going to put in? All right. They always say that, you should always inquire to see how much your employer puts into your retirement plan. A lot of times they will match your contribution dollar for dollar up to a total of maybe 3%. So, in other words, if you put in 1% of your pay, they'll match it. If you put in 2%, they'll match it. If you put in 3%, they will match it. Okay, after 3%, usually their contribution maxes out at 3%. Okay, now you're not taxed on their contribution. All right, the business gets an ordinary tax deduction for that, and it's just part of their payroll expense. and but it's added to your account, and then you'll pay taxes on it when you withdraw it. Okay. Also, when you have an employer-sponsored plan, there is a term called vesting that you have to be concerned with. All right, vesting means that whatever amount is in your retirement plan becomes yours after a certain period of time. Now, employee contributions, of course, you are vested immediately because that's your money. But employer contributions may be vested over a period of time, all right, to make sure that you're going to work for the company and stay there for a while, and so these contributions may vest in increments, over X number of years. Okay. We want to go ahead and take a look at page 426 and 427. All right, and the discussion there is about qualified plans. Now, virtually every retirement plan that you come across as part of on the W-2 form or on a 1099-R form is going to be a qualified plan. Now, what exactly do they mean by a qualified plan? Well, at the bottom of page 426, it tells you the 5 requirements for a qualified plan. And basically, they're pretty self-explanatory. Okay, they have to be available for all employees. They can't just discriminate, for the higher paid employees. All right. If you are at least 21 years old and you've completed 1 year of service, okay, you're eligible to participate. If the plan provides for 100% vesting of the employer's contributions to the plan, okay, they can require that you be there at least 2 years in order to qualify for the retirement plan. Okay, and then again, just like I mentioned, there are some minimum vesting requirements. All right, for example, how long you have to be there before you have access to all the money that your employer put in. Okay, they also talk about defined benefit and defined contribution plans. All right, most plans will be defined contribution plans. In other words, you put in 1%, the employer puts in 1%. Okay, all right. A defined benefit plan is when it's defined that you will receive X number of dollars when you retire, so it's not based on a percentage of your income. All right. One other thing that you should note, though, when you're doing a client's tax return, if they are in a retirement plan, okay, in other words, when the middle box in box 13 on Form W-2 has an X in it, okay, and again, that's the box that's marked W-2 or marked retirement plan on the W-2. Okay, this should automatically trigger a Form 8880, which is at the very bottom of page 427. They call it the Low Income Retirement Plan Contribution Credit, otherwise known as the Savers Credit. All right, well, when you check that box on the W-2, all right, that should automatically make that Form 8880 active, okay? And if you're wondering where the credit is, if you go to page 2 of the 1040 and look at line 51, that's where the credit is found. All right. Now, believe it or not, there is an exemption that where you don't get the credit if you're a full-time student, okay? All right, but the bottom line is if you don't have a large income, yet you made a contribution to your IRA or your 401k at work, you are eligible for the or for the Savers credit. Okay, so there are some AGI limitations on this. You can find that table on page 428 in your book. All right, but again, the software should automatically calculate that for you. But again, you would need to go to Form 8880 and check a few boxes. But that, that credit can be quite a lot. So make sure that you check that out whenever you do a client's tax return. Okay, that ends this recording.